Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. Today is 2026, May 8th, and we're doing the practical version of market chaos. What moved, why it matters, and what you can actually do about it.
I'm your guest, and I'm here to translate macro headwinds into why my grocery bill is auditioning for a Marvel movie. Also, we have oil drama, tariff drama, debt drama, and retirement drama. Basically the full streaming bundle.
Oil. We've got reports of crude around $101, with the Strait of Hormuz back in the spotlight. That's the narrow passage a huge share of seaborne oil flows through, so any military escalation or shipping disruption can spike prices fast.
So it's like the world's oil is trying to leave a concert through one tiny exit, and someone yells, "Fire!" Even if nobody gets trampled, everybody starts sprinting, and the ticket prices triple.
Exactly. The finance behind it is simple. Energy is a key input. When oil jumps, transportation and manufacturing costs rise, and that can feed into inflation expectations. Markets then reprice interest rate paths, sometimes even before the higher prices show up in official data.
But the article vibe is, could it go to $200? That's not a forecast. That's a jump scare. Are we actually supposed to plan for $200 oil? Or is that just clickbait with a necktie?
Treat it as scenario planning, not a base case. The useful question is, what conditions would sustain a move that extreme? Prolonged disruption, insurance and shipping costs surging, and limited spare capacity offset. Even without $200, 100 plus oil is enough to pressure consumer spending and corporate margins.
Actionable takeaway for regular humans. If oil stays high, it's not just gas. It's flights, deliveries, and the why is everything $2 more tax. So do we hedge, like buy energy stocks, or do we just cry into our receipts?
Before we hedge, Story 2, Tariffs. A U.S. trade court ruled the latest 10% global tariffs unlawful. That's a big headline, because tariffs act like a broad-based cost increase on imports, which can push prices up and complicate inflation and growth.
So the court basically said, no, you can't just slap a 10% cover charge on the entire planet. But markets don't trade court vibes. They trade what happens next. Appeals, new deadlines, new threats. It's policy whiplash.
Right. Even if the tariff is blocked, uncertainty remains a cost. Companies delay capex, reorder supply chains, and build buffers. For investors, that can mean higher dispersion. Some firms pass costs through, others eat margins, and some benefit from reshoring or alternative sourcing.
Here's my disagreement. People hear tariffs illegal and think it's over. It's not over. It's like your flight got uncanceled, but the plane is still missing.
Story 3. U.S. Debt Risk. Jeffrey Gunlock at DoubleLine is preparing for an extreme debt scenario, including the idea the government might restructure debt. That's not a prediction of imminent default. Think of it as flagging tail risk in a world of high debt and higher rates.
Wait, restructure sounds like when your friend says, I'm not broke, I'm optimizing my liabilities. Are we talking about the U.S. doing the sovereign version of, can I pay you next month?
In plain English, restructuring could mean changing terms, maturity extensions, different issuance patterns, or policies that effectively reduce real debt burdens over time. Historically, big debt loads get managed through growth, inflation, fiscal changes, or financial repression. Markets care because treasuries are the benchmark for everything.
So if treasuries are the risk-free yardstick, and the yardstick starts wobbling, everything measured with it looks weird. That's comforting. What's the non-doomsday move for a normal portfolio?
Before the checklist, Story 4 is personal. A New York Times piece reports more older Americans returning to work due to financial need, high costs, insufficient savings, or benefits gaps. This matters because it changes household planning and, at the margin, labor supply.
Fired from retirement is the bleakest phrase. Like retirement sent a breakup text. It's not you, it's inflation. If someone is going back to work, what should they watch so they don't accidentally nuke their benefits?
Here are the practical moves tying all 4 stories together. 1. Stress test your budget for energy. Assume higher commuting, utilities, and delivery costs. 2. Keep an uncertainty buffer in cash or short-term instruments if your job or business is trade exposed. 3. Diversify rate risk. Don't let your entire plan hinge on one interest rate path. 4. If you're near retirement, map income sources and check how extra earnings interact with Social Security, Medicare, and taxes.
And my final roast? If your plan is, I'll figure it out when oil hits $200, that's not a plan. That's a jump scare with spreadsheets. Do the boring prep now. Emergency fund, debt check, and a portfolio that can survive both court rulings and shipping lanes.
That's it for BD Daily Finance News Podcast. If this helped, subscribe and drop a comment. Are you adjusting spending, investing, or retirement timing because of energy prices or policy uncertainty? We'll be back with the next briefing.
Also, if you want a one-line rule, don't panic buy headlines. Price the risks, then buy the plan. See you next time.